Alright, today is Sunday, April 11th, and this is a recap for the stock market activities last week and an outlook for the week to come. We've been experiencing the low volume / Taylor Swift market phenomena. Matter of fact, this week we have experienced the lowest volume for the year. And we know that the path of least resistance in a low volume market environment is higher. In addition, we have been experiencing the portfolio rebalancing from institutional managers, and the theme is clear. They are buying technology ETFs, and therefore this week we saw big tech names, the likes of Apple, Amazon, surging higher. We have not seen a specific theme of rotation from one sector to the other in the market. We just saw more inflow into the market in general, but specifically in the laggard names, which happen to be technology names. Now, the market also managed to shake off many concerns. The likes of the surge in the PPI number, the Producer Price Index, which was the highest reading in over 9 years, signaling a massive surge in inflation. But the market yet again channeling its inner Taylor Swift and shaking off any concerns during the very low volume week. The problem is that this is the calm before the storm. There is a massive move coming in this market, and this move will be of conviction, meaning it will be accompanied by very large volume. Our job is to look at the facts, the technicals, and other indicators to figure out where is the next direction for this market. In addition, we have a lot to look forward to in this upcoming week, starting tonight with the 60 Minutes interview with Chairman Jerome Powell, which will probably be already out by the time this video is released. And then we have a slew of economic data, specifically regarding inflation. And the most important number to look out for is the CPI. We have an indicator here with the PPI. The CPI is expected to build on the concerns of higher inflation. We also have IPOs coming up in the market, in addition to earnings season. So we will talk about that and a lot more. We have a lot to cover in this video, so let's not waste any time and let's get this party started. And here we go. The Dow Industrial Average closing in the green by 297.03 points, or a gain of 0.89%. The Nasdaq closing in the green by 70.88 points, or a gain of 0.51%. The S&P 500 also closing in the green by 31.63 points, or a gain of 0.77%. The bulk of the gains that came out on Friday were during the last hour of the day. We saw a massive surge higher, and that is due to last-minute buying of portfolio rebalancing and short covering. The problem is with this move is its sustainability in upcoming weeks, meaning take a look at the blue meter next to the chart. The volume was extremely low, specifically for the Nasdaq. Matter of fact, the relative volume was half of the average, and therefore this is the calm before the storm. During low volume, you can do cute moves of pushing the market higher easily, but the problem is the sustainability of these kind of large moves higher. Either they will be confirmed with higher volume to come, or the higher volume will negate the move from the last couple of weeks. Moving on to the sector's performance for the market during Friday. Leading the pack at number 1, capturing the gold medal, industrials; at number 2 for the silver, healthcare; and at number 3 for the bronze, technology. The only notable laggard here on Friday was energy. Energy down big and leading the declines of the day. Let's contrast that with the picture for the performances of the week. At number 1, capturing the gold medal, technology; at number 2 for the silver, communication services; and at number 3 for the bronze, consumer cyclicals. The laggard for the week, once again, energy, so the theme is very clear. Taking profits out of energy and buying the dip in technology and growth names. Moving on to the futures market performance on Friday. While energy stocks had a terrible day on Friday, crude oil prices remained stable, which tells you that the move in energy stocks was due to a sell-off of profit taking. And as I informed you before from my sources, a lot of managers that I talked to are still bullish on energy, but they do believe that energy prices and energy stocks will continue to decline all the way till the summer. and then we will see a resurgence of crude oil prices and energy stocks. Now, I do disagree with that. I think that energy stocks will rebound sooner than many of those managers expect. Yet regardless, we saw declines, modest ones, for both WTI crude and Brent crude oil. What about softs? What's going on here? Lumber continues to gain higher and higher and higher, and this is part of the inflationary axis. Therefore, you have to contrast the picture between the gains in growth stocks and technology stocks this week and the performance of the axis of inflation, lumber, grains, copper in the futures market. One would assume that the rise of technology stocks came hand in hand with declines in, say, the prices of lumber or even treasury yields. That did not happen, and that is the first clue you need to understand to figure out the next direction of the market and the sustainability of the moves we saw in the market, specifically in the Nasdaq the last couple of weeks. If the declines in the Nasdaq were due to the rise in inflation expectations and treasury yields, then the massive bounce we saw the last couple of weeks, one would assume it came hand in hand with the decline in treasury yields and commodity prices. Not the case. Anyhow, we saw massive gains for two softs futures that I bought this week: cotton and sugar. We also saw modest gains for coffee, coca, and OJ futures. What about metals? We did not see a move one way or the other in the dollar index on Friday. Yet metals gave up some of the gains, with declines led by platinum, copper, silver, and gold. Meanwhile, palladium futures are the only futures that managed to close in the green. We have to decode the message here from the move in metals. Is the move in metals futures predicting that the US dollar will rebound higher once again? That remains to be seen. We will talk about the dollar index chart in details during the technical analysis. What about meats? Some give back in the gains for both live and feeder cattle futures. Meanwhile, lean hogs futures steady for Friday's session. And what about grains? The notable gainer in grains futures, wheat closing in the green by about 1.63%. Meanwhile, we saw losses and givebacks from soybean meal, soybean oil, soybeans, corn, oats futures, while we saw canola and rough rice futures stable. All in all, commodity prices remain elevated, and that should show up in the upcoming CPI report. Moving on to the big casino, the options market. Let's see what's going on here. The moves on Friday led by Apple. Apple was one of the best performers this week, up about 8% or so. And once again, under low volume, there were many tailwinds to push Apple's stock higher. Number one, the portfolio rebalancing, buying technology ETFs, and Apple has the biggest weighting in technology ETFs. Likewise, the elevated call options volume in Apple also acted as tailwind to push the stock higher. And on Friday, the volume for Apple remained elevated at about 2.7 million contracts. About 71.5% of those were calls. At number 2, Tesla, with a little over 670,000 contracts. About 56.5% of those were calls. And at number 3, we have Fubo, with over 600,000 contracts. About 76% of those were calls. Fubo surged over 12% higher on Friday because they have secured airing rights for qualifying matches for the upcoming World Cup. All in all, even though we have muted volume in the options market, the put-to-call ratio is heavily tilted toward calls. In certain cases, it is helping some of these stocks, the likes of Apple, but it is not helping some of the mania names, the likes of Neo, Palantir. In these names, we saw huge up days and down days throughout the week, and the volatility was higher in these names specifically. Whether it's Neo, Palantir, Plug Power, Zoom, etc., these names experienced high volatility this week. It wasn't smooth sailing for these names as it was for, say, big cap technology stocks. Moving on to the unusual activities that took place in the options market on Friday. Let's start with the ticker IHRT. This is for iHeart Radio. They're making a bullish bet here by buying the 20 calls expiration date May 21st, with expectations that the name will rise over 10% by then. They paid about $1 a piece to enter this trade, which brought the total all the way to $2 million. What about the trade for the ticker AAPL, Apple? Apple had a fantastic week, closing with gains over 8%. We discussed the reason behind the rise in Apple stock the last couple of weeks. But they are betting on more gains to come here by buying the 142 calls expiration date April 30th, with expectations that the name will climb over 7% by then. They paid about $1.25 to enter this trade, which brought the total all the way to $1.3 million. Now, I do disagree with this trade because under low volume and high flows in the market, Apple will gain. But if we see a resumption of volatility in the upcoming weeks due to a resurgence of treasury yields and inflation expectations, Apple will suffer. And the reason is Apple is the ATM of the market. If there is a sell-off and a panic in the market, Apple gets punished. If there is, on the other hand, inflow in the market in general, Apple benefits by default because it is the biggest ATM in the market. It is pretty much in every ETF out there, and it has a huge weighting. So once again, when you look at the charts and you contrast Microsoft with Apple, for example, and you say, why did Apple decline so much from the top while Microsoft remained stable? The answer is Apple is the ATM of the market. Likewise, this week we saw inflows into the market, and Apple managed to outperform every single big cap technology stock out there. Moving on to the ticker HOG for Harley Davidson. They're making a bullish bet here by buying the 45 calls expiration date June 18th, with expectations that the name will rally over 7% by then. They paid about $2 a piece to enter this trade, bringing the total all the way to $1.2 million. Continuing with interesting trades. What about the spread trade for Etsy? And pay attention here. Put that coffee down. It's a bearish spread. They're buying the 195 puts and they are selling the 190 puts for the expiration date of April 30th, with expectations that Etsy will decline over 10% but not more than 13%. The entry price for the leg they bought, the 195 puts, was $3.45 a piece. Meanwhile, they collected about $2.60 a piece from the leg they sold, the 190 puts. All in all, the entry price for this trade is 85 cents a piece, which brought the total all the way to about $380,000. Now, this trade is brilliant because the construction is very important in every trade. The success of any options trade depends on the following: 50% the construction of the trade, 30% the management of the trade, and 20% luck. In this case, the construction is perfect because the entry cost is 85 cents a piece, but the profit potential is $5 a piece. So if Etsy indeed declines by over 10% by the expiration date, this trade will be extremely profitable for whoever opened this trade. What about the trade for the ticker HD, Home Depot? Home Depot been a proxy play for lumber prices going higher and the bubble in the housing market in general. But perhaps the stock went too high too fast. At least this is what the trader is saying in this particular trade, because they are buying the 300 puts expiration date April 30th, with expectations that the name will decline over 6% by then. They paid about 85 cents a piece to enter this trade, bringing the total all the way to about $365,000. What about the ticker SQ for Square? And here's a little tip for you, little insider information. From what I know, there are big sharks placing bearish bets on Square, shorting Square. But they had a terrible week this week because Square blasted higher significantly. And the reason is we heard from Jamie Dimon, the grand Ayatollah of Wall Street, and he identified the new fintech industry as a threat for traditional banking. He did not name Square by name, but the market immediately assumed that he is talking about Square. And there is this hype of an upcoming M&A activities from the banking sector, specifically from JP Morgan. Now, JP Morgan is not going to buy Square. Square is overvalued, and it is valued at quarter of the valuation of JP Morgan, which is absolutely insane. But there will be lots of M&A activities in the banking sector to come. Perhaps as soon as this week during banks' earnings, JP Morgan will announce an acquisition of a smaller fintech company, but it's not going to be Square. Regardless, the comments from Jamie Dimon blasted the stock significantly higher, burning all of these shorts, but they are giving it another shot by buying the 240 puts expiration date May 21st, with expectations that the name will decline over 8% by then, and they paid $9.50 a piece to enter this trade, which brought the total all the way to about $3.6 million. What about the trade for the ticker DKNG, DraftKings? The stock blasted higher. We heard more news about upcoming legalization of online gambling, specifically from New York, and that helped the stock to blast higher. But somebody is calling a top here by buying the 58 puts expiration date May 28th, with expectations that DraftKings will decline over 7% by then. They paid about $4 a piece to enter this trade. All in all, bringing the total to about $1.5 million. Moving on to the headlines that shape the day, starting with macro news. What else? The big bomb we got on Friday, the PPI number, signaling a significant surge in inflation. Yet the market did its best Taylor Swift impression and shook it off. But here is the headline. U.S. producer inflation heats up in March as prices increase broadly. U.S. producer prices increased more than expected in March, resulting in the largest annual gain in 9.5 years, fitting in with expectations for higher inflation as the economy reopens amid an improved public health environment and a massive government funding. The producer price index for final demand jumped 1% last month after increasing 0.5% in February, the Labor Department said on Friday. In the 12-month through March, the PPI surged 4.2%. That was the biggest year-on-year rise since September of 2011. And followed a 2.8% advance in February. And we know that the cooks were busy at the Bureau of Labor Statistics in the morning because they're trying to hide the true picture of inflation to tamper inflation expectations. Yet even after their best efforts, the number was shocking and defied expectations by a lot. Economists, called by Reuters, had forecast the PPI increasing 0.5 percentage point in March and jumping 3.8% year-on-year, meaning that the number we got was double the expectations. The report was delayed after the Bureau of Labor Statistics website crashed. The cooks were extremely busy in the morning, and the cooks will be even busier during the upcoming CPI number. And here it is, the biggest gain since 2011. But hey, where is inflation? Is it right here? Is it right there? I can't see inflation. I can't smell inflation. I can't hear inflation. How about this inflation? The PPI number climbed higher in the fastest pace on record. A massive surge of inflation is coming. And the CPI, despite the cooks, their best attempts, will show and reflect that inflation is indeed rising higher. The consumer is already aware that inflation is rising around them all over the place. Households are being choked by housing prices, rent, gas prices, food prices. But the deflationary donkeys continue to tell us, oh, but TV prices, bro, the TVs are cheap. How many TVs do you eat per day? You morons. The 4.2% year-on-year number for the PPI is the second largest gain ever in the history of the readings of the PPI. But where is inflation? Is it here? Is it there? Where is it? Even the Chinese Communist Party numbers are not hiding the truth, having difficulty hiding the truth. But somehow the Federal Reserve and the Bureau of Labor Statistics here in the United States have absolutely no shame whatsoever. When you can trust the CCP number over the CPI number, what's going on, what's happening in this country? Asian stocks fall after Chinese inflation data surprises to the upside. And here we have this conflict, inner conflict behind the scenes going on at the Federal Reserve. Dallas Fed President Kaplan, we talked about Kaplan many times in this program, him and his famous leather chair. Oh, he loves to sit. But I have the feeling that Kaplan is more concerned than Jerome Powell, and he's trying to indirectly tell Jerome Powell via his interviews and statements to the media that you better be careful here, Mr. Powell. Kaplan says he wants the Fed to avoid being quote-unquote late on tapering. Translation: President Kaplan is saying, cut, it's over. The movie's over. The party is over. But are market participants listening or not? Of course not. And by the way, if we get Kaplan, we buy him a couple of beers, maybe a few puffs of hashish, and let him loose. I have no doubt in my mind that he will tell the truth. That what Jerome Powell is doing right now is extremely risky, and it is playing with fire. We have this conflict going on within the Federal Reserve, and it's going to become more evident if we see more and more inflationary pressures. The man is saying we will taper, and it better not be late. So this whole not thinking about, that's all bullshit. You have to be an absolute moron to believe the Federal Reserve. Matter of fact, inflation is rising higher. Many countries are suffering shortages of food and supplies when it comes to vegetables, grains, fruits. And here we have the UAE, and the UAE is having difficulty importing the food that they need. And therefore, they're thinking about growing their food locally in the desert. The United Arab Emirates, most of which is desert, said it should be able to triple the proportion of its food that is local within a decade. They have to speed up this project because the shortages of food is real. But perhaps you don't have to grow food in the desert because here is the future, bro. Forget the ocean. In the not too distant future, the succulent lobster meat you dunk into butter or pile of rolls might be grown from cells in a Wisconsin laboratory. And this is indeed the future. We have a massive surge in population, yet the food resources are very scarce. And therefore, we're going to have to use technology. You want to talk about deflationary forces? Here comes the deflationary forces, but they're not anywhere near the immediate horizon. The future is growing food in labs, because with the rise of population that we have right now, it is pretty much impossible to produce all the supplies that the world needs in terms of grains, vegetables, fruits, and other edibles. We're talking about food here, not weed. So wake up, put that coffee down and put that reefer down and pay attention. Because there is another company in Singapore that is already growing meat in a lab. And this is indeed the future, bro. Now the Robin Hoodies are going to go online and look for tickers for online meat labs, and perhaps they're going to buy the wrong ticker. For example, when they bought Telsa instead of Tesla, you know the deal. Shifting to the state of small business in this country, not going so hot so. While Wall Street is partying and having orgasms every single week, small business is feeling the bulk of the pain. Meanwhile, the Federal Reserve continues to say that our current strategy is working and we need to do more of the same insanity to help small businesses and mom and pops, the poor, the middle class to lift in this recovery, quote unquote recovery. But here it is. U.S. small business closures are ticking back toward COVID pandemic highs, because while the tsunami of liquidity is abundant for Wall Street and public corporations, it is very scarce for small businesses. They cannot survive whatsoever. A public company listed in the stock market can rack up an insane amount of debt, issue more stocks, dumping on the heads of the morons, the zombies, and getting out of the woods. Small businesses don't have that option. But perhaps there is a light at the end of the tunnel, because the consumer is speaking loud and clear. The consumer in the states that reopen are choosing to buy from retail brick and mortar businesses rather than spending online. And perhaps this is a very important movement that we all should participate in. Once you are able to go out safely and consume, choose to consume in small businesses, and let's boycott Amazon for at least a month. Let's show this bald-headed prick, Jeff Bezos, who benefited from the pandemic, that we still appreciate and support mom and pops and small businesses, whatever left of small businesses. 1 month, no Amazon. Get your ass off the sofa and go shop in small businesses. Because if you do not participate in this, and this is not the only impact from the Federal Reserve policies, destroying small business to benefit large public corporations, but it's also causing the largest wealth disparity in history. The top 10% of Americans own about $85.6 trillion in wealth. Meanwhile, the bottom 50 only own $2.5 trillion. A fraction of a fraction of a fraction. Thank you to the Federal Reserve. More in macro news, specifically regarding the wall of worry and the state of geopolitics. You know, the market is channeling its inner Taylor Swift, shaking off every worry whatsoever. But these worries are going to pile up. They're going to hit the market out of the blue. Here's an update regarding the tensions between the United States and China, specifically regarding Taiwan. The Chinese Air Force sent a fleet of aircraft close to Taiwan for the second time this week. And here's what's going on with the Biden administration regarding defense spending. I've been maintaining my stance, my bullish stance that is, on defense stocks because there is no value to be found in the market. If you are looking for any value in the market, it is very hard to find, including within value stocks. One of the few pockets of value left beside the drug manufacturers in the healthcare sector is defense contractors. And therefore, a few weeks ago, I bought Lockheed Martin stock. Despite the experts being bearish on defense stocks because the Democrats are in charge and they're not going to spend as much as the Republicans on defense, etc., etc. I told you from the beginning this is BS because if anything, the Democrats will spend more than the Republicans because they are once again owned and beholden to the military-industrial complex. You have this illusion of Democrats versus Republicans, Team Blue versus Team Red, when in reality it is one party. It is one purple party. And their job is to screw you over and over again. Bernie Sanders expresses serious concerns over Biden's proposal for modest increase in Pentagon spending. Once again, modest increase. Not decrease, increase. The Biden administration is asking Congress for $753 billion to fund the U.S. military operations. That is a slight uptick over last year. Senator Bernie Sanders said he has serious concerns about spending money on a bloated Pentagon. Now, the hawks, the likes of Colin Powell and John Bolton, did not endorse the Biden administration, expecting that they will cut defense spending. While we're printing money and spending it all over the place, might as well increase defense spending. Why not? Run that printer machine until it explodes. Speaking of the printer machine, here it is. President Biden proposed major boosts in funding to combat inequality, disease, and climate change as part of a $1.52 trillion budget request for 2022. Once again, opening a wider budget gap than before. Who's going to pay for all of this? At some point, your taxes are going to go higher. I know you continue to dismiss that. Oh, it's just going to be corporations or we don't need to increase taxes. No. Your taxes are going higher, specifically if you are in the middle class, because the government and the Federal Reserve are adapting MMT, modern monetary theory. And their goal is to fix all of the problems that our society had for years and years and years by thinking that pouring more money on the problem will fix it. And they are printing, racking up more debt and more debt and more debt. The problem is that will be accompanied with inflation, and inflation will get out of control, and the Fed will have to taper by increasing interest rates and perhaps tapering the cocaine operation of asset purchasing, including bonds. So the government will be left with their pants down and they will have to increase taxes substantially to pay for all of these projects. Now, don't get me wrong, this country is in dire need for infrastructure, new infrastructure spending. The problem is that the bill is not honest. They say it's $2 trillion for infrastructure, but the truth is only a portion of that goes to infrastructure and the rest goes to miscellaneous spending, quote unquote miscellaneous. Moving on to market sentiment news. The market pretty much recovered all of the correction, quote unquote correction in the NASDAQ, pullback, whatever you want to call it. But the devil is always in the details. We'll talk about that in a little bit. But the last couple of weeks, we have witnessed orgasms and orgies all over Wall Street. We're out of the woods, big cap technology is coming back. CNBC experts on Friday said, does inflation even matter? And they declared Jerome Powell, quote unquote, won. The problem is, all of that happened under extreme low volume and under the umbrella of portfolio rebalancing. And money managers have a problem. It's a problem that a lot of us wish to have, which is too much money. They have a tsunami of cash thrown at them. They have to deploy the money regardless of any concerns. Overvaluation, no overvaluation. If there are morons giving us billions of dollars to deploy in the market, we can't hold it in cash. We have to deploy it somewhere. So we're going to buy the dip in the quote-unquote reliable names, big cap technology names. Perhaps some banks here and there, some industrials, but we gotta buy something, even though if it was my money, I wouldn't buy the market right now. This is what money managers are saying. If it was my personal money, I wouldn't be buying at these valuations. But I have to do it because pension funds, retirees, whatever, they're throwing billions and billions of dollars at us. We have to deploy it somewhere. Regardless, the geniuses in the financial news media did not tell you these details. They just had one massive orgy the last couple of weeks. But once again, the devil is in the details. And we have a very large move coming. That move could be to the downside. And here is the big bet that caught the options market by surprise. Giant VIX options trades bet that the stock market calm would not last. Somebody shook up option screens Thursday morning with a wager that the VIX index will rise toward 40 and would not be lower than 25 in July, up from about 17, the level where the volatility gauge currently trades. The trader appears to have made several block trades, buying a total of about 200,000 call contracts. That's almost as big as the total daily volume of VIX calls, based on the 20-day moving average. Now, we kind of have a clue of who that person is behind the trade. But remember this, last year, February 2020, when everybody was having orgies and orgasms all over the place, all-time highs after all-time highs, what virus in China? What are you talking about? The market is so resilient, yada, yada, yada. Somebody made a massive put option trades for the SPY. And these were not just your regular insurance trades. These were bets that the market will crash. And we now know that the person behind that trade was Bill Ackman. The person making this trade is betting that the market will crash. They are not buying protection. This is not a protection or insurance trade. This is somebody with high conviction saying that the market will crash. And I know that a lot of you messaged me with frustration, asking when is the top? When will this market crash? It is getting ridiculous. It's unbelievable. It's beyond anything that is explainable. When will the market crash? When will the bubble burst? Are you ready for it? Are you paying attention? Once again, put that coffee down and pay attention. It's probably not coffee what you're drinking right now. It's probably a glass of Bordeaux. But anyways, put that down too and pay attention here. The bubble has already bursted. You're just not paying attention. You want to know why? Here is legendary investor Jeremy Grantham.
If you're looking for the very early warning signs of a bubble breaking, you find the stocks that have done the best, SPACs and particular SPACs and Tesla and Bitcoin. And you wait until they start to have these big daily drops, and then they recover and they drop and they recover. And that's the very early warning. And the market in 2000, for example, didn't go together. They took out the pet.coms and shot them. The rest of the market continued to go up. It didn't even deign to notice the shooting of those little guys. They were only worth scores of millions or a couple of $100 million. Then they took out the junior growth stocks and shot them, and the market kept going up. And then they took the medium growth stocks and shot them. And finally, by the summer, they were shooting the Ciscos. And the entire tech part of the market had been shot. And that had been 30% at the market peak of the total market cap. And yet the S&P by September was at the co-equal high of March, which meant that the other 70 had continued to rise. So that is a typical way. Bubbles don't necessarily break en masse, but having sliced off the tech and the dot-coms, then finally the 70%, like a giant iceberg, rolled over en masse, the 70%, and went down for 2.5 years by 50%.
And indeed, the crash, the dot-com crash that is, did not come at one bulk. The market did not crash at once in a single day. There were warning signals all the way back in the fourth quarter of 1999, with Amazon giving up a lot of the gains, Pets.com crashing, the Globe.com crashing. Of course, I don't have these charts for you, but I have another mania name from the dot-com bubble, Qualcomm, and the poster boy of the dot-com bubble, Cisco. Notice the contrast here. Qualcomm was one of the biggest mania names in the dot-com bubble, one of the most insane surges in history. And you had new investors buying Qualcomm. It is the future, bro. And they were called the Qualliumnaires. They became millionaires out of the blue, and they bought Qualcomm and continued to push it higher based on, quote-unquote, the future, bro. Every phone in the future will be CDMA. Qualcomm will be in every single phone. You know what? They were right. Qualcomm is indeed in every single phone. Regardless, the stock crashed and did not recover the highs of the dot-com bubble for about 20 years. Because here is what matters. Valuations. 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 Your donkeys. It's the same story with Cisco, by the way. The internet is the future and the internet will not exist without Cisco. Well, they were right. The internet is the future indeed, but it does exist without Cisco. Regardless, Cisco is a massive company today, but it still hasn't recovered the dot-com highs because once again, valuations. But the point to illustrate here is, look at the chart. Cisco in orange, Qualcomm in baby blue. Now, going back to the beginning of the year of 2000, Qualcomm gave up first, crashing before Cisco. And then Cisco, almost a year later, started crashing. And the Nasdaq gave all of the gains from the dot-com bubble and continued to decline for over 2 years. Sounds familiar? Let's see what's going on today. In our bubble 2020-2021, Blink Charging, one of the mania names, down over 61% from the highs. Neo, down over 50% from the highs. Palantir, down over 50% from the highs. Plug Power, over 60% from the highs. And by the way, Plug Power was a mania name during the dot-com bubble. And these donkeys today did not learn from the exact same mistake 20 years ago. But they keep telling us it is the most educated generation. Give me a break. If it was the most educated generation of investors, they would have used Google and they would have figured out what happened to Plug Power during the dot-com bubble. Here's another name, Tesla, down about 40% from the highs. So we have already seen the crash in the mania names. As Jeremy Grantham said, they might recover again, not all the way to the highs, but they might bounce higher again. But this is the warning signal that the bubble has already bursted. It is just a matter of time before the big stocks start crashing too. We're talking about Apple, Amazon, Microsoft, etc. It's all gonna come, and this is the warning signal. Here is yet another illustration for you that the bubble has already bursted. The performance between IPOs versus the Nasdaq. IPOs during the heat of the bubble outperformed the Nasdaq. This is the similar story we saw back during the dot-com bubble. But IPOs started to crash before the Nasdaq crashed in the year 2000. We're seeing the exact same phenomena happening right now. IPOs crashed, the Nasdaq continues to rally higher. It is just a matter of time before the lag in response from the Nasdaq catches up with the downward move, aka the crash in IPOs. But are market participants even listening or paying attention to the warning signals? Of course not. Investors, quote-unquote investors, have put more money into stocks in the last 5 months than the previous 12 years combined. The largest inflow to equities ever. And this is yet another illustration of the problem of the tsunami of money supply. Money is floating everywhere, and it has to land somewhere. It has to land in any store of value, and therefore you're seeing Bitcoin rising higher, but in this case equities, because that is the natural place for money to go. The problem is that is just going to make the bubble inflate bigger and bigger and bigger. And once that pop happened, I already told you the pop already happened, and the big pop is about to come. All of these inflows, historical inflows, will have to rush to the exit door at the same time, and that will create one of the biggest crashes in history. And here is for those who doubt the low volume phenomena. On Friday, we have experienced the lowest volume of the year in the stock market. No wonder why we saw stocks surging higher. Now, every time we see those historical declines in volume, low volume is followed by a surge in volume. And the surge in volume usually, not always, but usually creates a reversal in the movement we see during low volume. In this case, it will be to the downside. And by the way, they're pouring all of this money from pensions, retirees, states, schools, hospitals into the market at the highest and most insane valuations ever. Here is the price to sales ratio for the S&P 500, far exceeding the dot-com bubble highs. We're not talking about price to earnings. We're talking about price to goddamn sales. You have to put a gun on my head to buy the market at these levels. But when you are a money manager and it's not your money, who cares? Another one from Bank of America showing that we will see peak earnings per share in the second quarter, meaning that earnings will start to reverse lower after the second quarter. But hey, good entry point, bro. And what about the 21st century's tulip mania? Here is more from Peter Thiel. It threatens fiat money, but it especially threatens the US dollar. Peter Thiel is turning against Bitcoin over concerns of China using it as a weapon to devalue the US dollar. Peter Thiel did not stop with his criticism for Bitcoin, but he also extended his criticism to Apple and Google, saying that they are too close to China. And it's not just Peter Thiel. We have Novogratz, who is a Bitcoin bull, by the way, and he is now saying that the US will face existential crisis if it can't engineer a digital US dollar soon. And here is from Kaplan, the Dallas Fed president, aka chairman, not the actual chairman, but because he likes chairs. Bitcoin is a store of value, but flunks the currency test. And here we have HSBC warning their clients for investing in Bitcoin and specifically in MicroStrategy. You know, with the maniac who's going all in buying tulips? Now, HSBC, this is ironic and quite comical from them because they were caught laundering money for terrorist organizations. But regardless, even they are turning against Bitcoin. I'm telling you, they're coming for Bitcoin. They're coming for cryptos. The digital dollar is coming. But hey, Pomp says it's going to the moon. I tell you, this Pomp guy is a fart of this bubble, just like the farts we saw back in the dot-com bubble. Looking like a genius right now, looking like an absolute Dumbo after the fact. The problem is he will still keep his money, you will not. But for the crypto maniacs out there, I got some good news for you. Here are the inflows, gold versus Bitcoin. Net inflow in BTC, net outflow from gold. And perhaps this is the most important catalyst, the most important tailwind to come for Bitcoin prices. The upcoming Coinbase IPO. This will be one of the most significant events in this upcoming week because two reasons. Number one, the implications for this name on Bitcoin and other crypto proxies. Number two, it will give us a pulse on where retail traders are. Retail traders have been quiet and absent from the market. Will this new IPO excite them and bring them back? This is why the Coinbase IPO is extremely important this upcoming week. Moving on to corporate specific news, starting with the evil empire of Amazon. Amazon was under the threat of unionization in Alabama, but the vote came out favorable toward Amazon and the union dreams were crushed. And of course, Amazon says there was no intimidation for voters and workers. We did not intimidate anybody. And here is the sad truth. Those who voted against unionization voted against their own interest because whether you like it or not, automation is coming. Whether there is a union or no union, automation is coming. All of these jobs at Amazon warehouses will be lost to robots. So you might as well want to juice them on the way out. And I know the apologists out there for corporations, they are a sad bunch, by the way, because they believe that it is their job to defend corporations like Amazon, who destroy unions and don't even pay their taxes, because they have dreams of becoming successful themselves one day. Or they are small business owners, and they don't want to deal with unionization or higher wages if they expand and become bigger. The problem with these people is that they are living in a lucid dream. They're living in fantasy land. They believe that the American dream is still alive and they will make it big someday, and they have to choose the corporation sides, not the workers' side, etc. Now, unions haven't been innocent throughout their history, but that's a different story. The point to make here is that it is a big club and you and me are not in it, and you will never be in it as a small business owner. You will never make it. I guarantee you. The American dream is dead. You might say, oh, you're so doom and gloom, you're so pessimist. Maybe you should remove the glue between your eyelids and see the reality. You will never, ever make it absent of a blessing from these oligarchs who rule the country. Automation will happen regardless of higher minimum wage, regardless of unionization or not. These jobs will be lost, and we will be left in a future of higher inflation and higher unemployment, meaning stagflation. You will have a very selected few owning the entire wealth of this country, and the rest of you will be living in a booth in one of these futuristic video games with your digital wallet, and you will have to take a UBI from the government. The digital dollar in your digital wallet. If you don't obey the rules, you don't be a good old boy and girl. God forbid you criticize the government, or God forbid you criticize one of our oligarchs in Wall Street or Silicon Valley, the government will punish you by freezing your digital wallet. That is the future. But keep defending Jeff Bezos and believing that someday you will be successful as him with your little small business, which will be lost, by the way, to Amazon sooner or later, because here comes the robots. This is what your little small business will compete against. And of course, they're saying, oh yeah, don't worry about jobs being lost to robots, because we're going to create more jobs. And the guy says one person will be operating 5 to 10 robots, meaning, yeah, we will lose thousands of jobs, but hey, we will create 100 jobs. So, and look at these robots, they can do the mashed potatoes. Aren't they cute? Wait till these robots steal your spouse. They already stole your job. Next thing they're stealing is your wife. My wife cheated on me and left me for Atlantis. Who's Atlantis, bro? He's a bot. They can replace men easily, but he can't replace women. Because as Reverend James Brown says, I sympathize with the man that don't have a woman. He's lost in the wilderness. He's lost in bitterness. He's lost in loneliness. He is lost in the future, bro. But perhaps not everybody's giving up here, and we have the DoorDash workers fighting back by gaming the system. A group of DoorDash workers is trying to game the app into paying drivers a $7 minimum rate for deliveries. Moving on to EV news. You know, a lot of you asked me whether the rise in oil prices will be a catalyst for EV stocks to rise higher. EV stocks are pricing a lot of things, specifically the mania names, NIO, Xpeng, Tesla, etc. General Motors and Ford, that's a different story. And perhaps this is a better news for General Motors and Ford than rising oil prices. President Biden's proposed infrastructure legislation rings in at $2.25 trillion and includes a big sum of money specifically for electric car rebates in the price. So all of these credits and rebates for buying electric vehicles will be restored, which will benefit every EV manufacturer, but specifically Ford. The problem is with Ford is the following. A Mustang Mach-E bug leaves cars stuck in quote-unquote deep sleep with an empty 12-volt battery. What's wrong with just a hybrid car? I'm not a fan of these EVs, by the way. Number one, it is a dirty business. Mining for nickel and cobalt is extremely harmful to the environment. But hey, so long as our politicians, the likes of Nancy Pelosi, is all in buying Tesla 600 Colts expiring 2022, perhaps this is the biggest catalyst for EV investors. You see what I'm talking about? If you're long Tesla and you are worried about a crash, Nancy Pelosi got your back. The Nancy put. Tesla will never go under $600. Otherwise, Nancy loses money. And speaking of the souffle, let's talk about NIO, because NIO has produced 100,000 vehicles. They're catching up with the souffle and closing the gap significantly. And Reverend Elon Musk, of course, congratulated NIO on this milestone. What he doesn't realize is NIO is coming for his lunch. First step is steal his technology, produce reliable, good vehicles, the likes of NIO and Xpeng, and then ban Tesla from the Chinese market and underprice Tesla in international markets. Ta-da! The souffle is over now. But hey, perhaps Martians will buy the souffle, so keep the hope alive. Speaking about the souffle and hopes and false dreams, did you guys catch this? And Vice magazine called this project the most embarrassing infrastructure project in American history. And the reason is, while China builds railroads and sophisticated public transportation in months, connecting thousands of miles, here in the US, we have third world country infrastructure. The corrupt politicians been talking about a train network between California and Nevada, between LA and San Francisco, even a metro station that connects Las Vegas airport all the way to the hotels in the Strip. And that never happened. They've been talking about these projects for years and years and years. And this is the easiest project ever. Las Vegas is a desert. You can build a metro station connecting the airport with every single hotel on the Strip easily. That never happened because we have corrupt, incompetent politicians leading this country and pretty much every single state in the union. And here we are bragging about a tunnel with Tesla cabs and disco lights. Wow, what an innovation. What a leap forward in infrastructure. First of all, the tunnels run under one property, the convention center. You can take Tesla cabs in a tunnel underneath if you don't want to walk across the convention center. Because you know, we don't have an obesity problem in this country at all. Who needs walking? And the other catch, as everything with Tesla, It is a bunch of lies and deception. First, they told us the taxis will be autonomous. Now they're saying, oh, they're actually going to be drivers driving these cabs in a tunnel underneath the convention center. But don't worry, because the autonomous vehicles are coming in the future, just like the robo-taxis we promised you and never delivered. This is the biggest con man on the planet. Delay, 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 make a false promise after another without delivering anything, all just to hype up the stock higher. And here is more regarding Reverend Elon, the king of deception. He has another startup called Neuralink, and they are experimenting on a monkey by implanting a chip inside the monkey's brain and illustrating that they can use the chip to make the monkey play video games. Oh, how cool is that? And Reverend Elon, once again, false promises, more deception, saying that the chip in the future, just like the robotaxis, will allow paralyzed people to be able to use smartphones. And regarding animal cruelty, the cultists claim that they are saving the environment and they behold the highest standards when it comes to ethics. But when you talk to them about the monkey and they're experimenting on the monkey's brain, they say, oh, Reverend Elon says that the monkey is happy. Well, the monkey is happy? Did you talk to him? So here you go. This is the future. You're going to go in your little booth, because you know housing is out of reach in the future, with your little digital wallet and your little digital brain with the chip controlled by the government. Obedient workers. We want obedient workers. Moving on to the heat map analysis from a weekly perspective. Once again, the inflationary trade of financials, industrials, materials, energy, and defensives continue to gain momentum. With exception of energy, this week we saw outflow out of energy stocks. Yet the bulk of the pain came from the high beta energy stocks. And therefore, I keep telling you, stick with the larger producers. Exxon, Chevron, BP. BP was down barely 1% for the week, but we saw significant losses for names like Occidental, Valero. If you're going to pick these names, understand that they are highly levered, and if we see a rise in interest rates, perhaps higher and sooner than we expect, these names could react negatively. The other theme from the week is the inflow for big cap technology stocks. Massive gains led by Apple, Amazon, Google, Microsoft, Facebook, closing with massive gains in the green. Likewise, the reopening trade still holding. We're still experiencing inflow in these names: cruises, hotels, airlines, etc. By contrast, we have a mixed bag when it comes to the mania names. We had high volatility when it comes to these mania names. We saw massive up days and massive down days, and that resulted in a mixed bag. Certain names managed to close severely in the red, the likes of Li Auto, Neo, Xpeng, Pinduoduo, Snowflake, even the solar names. They have experienced large gains during the week, but we also saw large declines. So all in all, it was a negative picture for solar stocks. But certain names managed to close in the green regardless of big down days. We're talking about names like Peloton. Peloton got upgraded by Credit Suisse. And a name like Square closing with over 14% in the green due to the comments from Jamie Dimon. But let's get to the specifics here by reviewing the themes of the market, starting with the reopening names. This is the weekly performance, by the way. All in all, it is a positive picture. We have some losses here, specifically for names like Molson Coors and Coty, but all in all, positive picture for the reopening names, meaning we're seeing inflows into these names. What about the inflationary stocks? All in all, positive picture for the inflationary names. Again, net inflow for these names. Likewise, the deflationary stocks, specifically the mania names within the deflationary stocks, experienced massive gains. And the reason is we saw a pause. Some will characterize it as a pullback in treasury yields. And that was good enough for these mania names and tech stocks to surge higher. The sustainability of these moves are in question, specifically if we see treasury yields rising higher once again. But regardless, massive gains for names like Snapchat, Nvidia, Square, DoorDash, all with excellent gains this week. The take here from the themes analysis is: low volume is the tide that lifts all boats, because the path of least resistance is higher, and therefore everything managed to rally this week. The question is, what will be the market's reaction once we see the return of volume in the market? And for that, we are moving on to the charts analysis, starting with the SPY 30 minutes chart. Once again, low volume, gapping higher overnight, no resistance whatsoever. The sky is the limit, and the SPY continued to surge higher and higher and higher. The problem is we're leaving so many gaps below that have to be filled. And after a massive move like we saw last week, the expectations are that we will see some sort of a pullback this week, whether it is the return of higher volume or perhaps a reaction to earnings. We have some earnings from financials, Delta Airlines, United Health, and that could impact the trajectory of the SPY. What about the weekly picture? For the SPX, the cash index, I told you that this is the most important chart to watch during last weekend's coverage. And the reason is we have a rising wedge and the expectations are that we're going to break to the downside. The break happened to the upside, and I am calling a bull trap here. And I'm taking the risk, by the way, by making a bold call like this because the consensus is that we are out of the woods. The VIX is below 20 and the SPY is on a breakout. The problem is we have this breakout on a very low volume and therefore I am calling bull trap. I will take the heat if I'm wrong, but I'm not buying this move higher. And to make the picture clearer for you, here is a daily picture of the continuous contract of the S&P 500. We are starting to reach overbought territory in the RSI. Number two, while we are on a breakout and we have a bullish formation, we did leave a gap in the futures contract, the continuous contract, and this is not normal behavior that is usually quickly corrected by the chart. And I do expect the chart to go down to close that gap and perhaps while at it go all the way back to 3,960 and retest that line for support. Remember, I gave you two scenarios of the upcoming pullback. It could be a gap down during the overnight session. That's not going to be a strong signal for a reversal. But the strongest signal for a reversal is what is called a gap and crap, meaning you gap overnight, opening significantly higher in the morning, and then you see a sell-off throughout the day, losing all the gains and closing in the red. Could it be due to a reaction to earnings? Could it be due to a reaction to the release of the CPI number? Doesn't matter what the reason is. You know how to spot the reversal. Moving on to the Qs. 30 minutes chart. Similar story here with the S&P 500. We have a bullish breakout, a series of bull flags, but we're also leaving gaps open. And this is not a healthy behavior. You're going to have to go down and close at least the majority of these gaps. And the center of gravity for the chart right now is 323. Meaning that I do expect to pull back all the way to 323 and retest that line for support. Doesn't have to be necessarily for one long shot all the way down to 323 because we do have some other minor support lines below. What about the continuous contract of the Nasdaq? We had the reverse head and shoulder formation breaking to the upside, surpassing the very important resistance line of 13,599. The next level to look at is 13,900. This level will act as a magnet. The chart already did the heavy work, going all the way closer to 13,900, and therefore the level will act as a magnet. And we could reach that level during the overnight session. The question is, will you be able to surpass that level and open higher with another gap, or will the chart face some resistance at this level? My bet is this level happens to be the all-time highs. You're not going to be able to break above it easily. You have to at least spend a day or two, just like you did with 13,599 before breaking higher. But once again, please remember the difference between technicals and fundamentals. The technicals for a chart like this is bullish. If you remove the ticker and all the other conditions and you show me this chart, I will tell you that the chart is showing extreme resiliency and the bias is to the bullish side. The problem is when you combine the fundamentals, for example, treasury yields. If we see treasury yields rising higher once again, that's going to put a stop to the rise in the Nasdaq. What could be the catalyst for a rise in treasury yields? The upcoming CPI number. So once again, this is the most comprehensive coverage on YouTube for financial markets because we're combining technicals with fundamentals, with the news, with the options market. So I present you with all the facts and it's up to you to decide what to make of it. Moving on to the NDX, the big Nasdaq weekly picture. We discussed this chart before. last week, and I gave you the number and the line in the sand, 13,414. If you close above that number from a weekly perspective, then the bear flag goes out of the window. So what are we looking forward to in this chart? Here it is. The bulls are looking for a cup and handle formation, meaning that the chart could pull back all the way to 13,414, and that will be the handle, retested for support and then blasting higher once again. And this is extremely similar to the pattern we saw back in September of last year. We saw the correction, and by November, the market was pulled up higher again. And it is yet another similar cup and handle formation. The difference is that back then, we saw the participation of retail traders. You saw the overnight gapping in November by the passive institutional investors, but that was quickly picked up by retail participation. This time around, we're seeing the gapping higher via passive participation from institutional investors. Will we see the return of retail traders and investors to pick up the steam and push this market higher? That remains the $1 million question. And we do have an indicator in this upcoming week in the Coinbase IPO. If we see a huge demand in the IPO, then you know that the retail trader is still here and will be able to push this market higher. Moving on to the IWM, the Russell 2000. This is the most important chart in the market, along with the 10-year Treasury yield. From a 30 minutes perspective, we have a bearish consolidation, but you cannot make a solid conclusion one way or the other based on a 30 minutes chart. You do have the gap at 218 that has to be closed at some point. Does it have to be right now, immediately? And therefore, we're switching to the daily chart of the RUT, the big Russell 2000. Unlike the NDX, the RUT did not fulfill the line in the sand, meaning the line in the sand was 2,264. You get a close above that level from a weekly perspective for the bearish formation to go out of the window. That did not happen, and we haven't had a successful crossing in the MACD indicator. So the question is, did we just make a lower high, and in essence, a head and shoulder formation, and we will dive lower? For now, the chart is tilted toward the bear camp. Add to that the negative divergence in the RSI, and the bears have the advantage in this chart. Moving on to the dollar index, the DXY, and let's see what's going on here. We were expecting a pullback all the way to the level of 92, and indeed we got that. Now the level of 92 should act as support. Whether that will be enough for the chart to bounce higher or not, that's a different story. We have to watch out the pattern of higher highs and higher lows. If you start breaking that pattern, then the dollar index will continue to dive lower. And if you had to bet here whether the dollar index will bounce higher or lower, let's combine the technicals with some facts. For example, the currency in circulation. And during the month of April, we have seen an increase in the amount of currency in circulation, meaning that this piece of information is supporting that the US dollar will break below the support of 92. What does that mean for gold? Gold has been consolidating under the resistance of about 1,750. Now, if the US dollar breaks below 92, the expectations are that gold will be able to break above 1,750. The problem is that gold has another whammy working against it, and that is yields. If yields surge higher this week, then gold will struggle to rally. And therefore, I am avoiding gold for now, because if you are betting for gold to rally higher, you're betting on two factors, the dollar index and yields, to decline. That is a tough fight. You're fighting a 2 against 1 fight. I'm not interested in that fight. What about Bitcoin? What's going on here? Are we making a lower high? That remains the question. We're also watching for the imminent crossing in the MACD. Will it be to the upside, or are we going to get rejected once again? The other indicator to watch is the RSI. We do have a negative divergence, but the chart made significant progress toward breaking that negative divergence. So if there is a massive move coming in Bitcoin, and if I had to lay a bet, knowing that we have the Coinbase IPO, my bet is that the next move, the next big move in Bitcoin will be to the upside. I do have the price target of 68,000. What about yields? Along with the IWM, the Russell 2000, the two most important charts to watch in this market. Once again, did we indeed catch support from the level of 1.6%? And are we bouncing higher, creating a higher low? If that is the case, then we have higher readings for Treasury yields. Once again, the market was in its best Taylor Swift impression, shaking everything off. But perhaps we have a lagging reaction here to the PPI and the upcoming CPI number. We will see yields surging higher once again. At least this is how I see it for now. What about the TLT bond prices? Here is a weekly picture. We talked about the Fibonacci levels. We talked about the bullish scenario of an ABC pattern. But let's take a look at the big picture. From a weekly perspective, this looks a lot like a bear flag consolidation that is about to play to the downside. And once again, if we have a closing below 134.5, then that is a confirmation that the TLT will continue to dive lower, at least all the way to 128. What about the VIX? Another chart to watch. And I am highlighting for you the massive bet that we saw in the options market. Somebody's saying that all of what you're doing right now is stretching the band for the VIX to rocket higher, to the moon, bro. All the way to the reading of 40. That is an increase of about 140%. If this person is correct and the VIX is about to shoot significantly higher, then we're not looking for a correction. We are looking for a crash in the entire market, specifically the SPY, because the SPY trades in an inverse relationship with the VIX. If this person is right and the VIX is about to shoot higher, then we will see pain across the market. Financials, inflationary, non-inflationary, reopening, stay at home, doesn't matter. Everything is going to go down. For now, the take is we do have a gap at around 19.5. And this gap happens to be above the current reading of the VIX. So once again, if we are expecting the S&P 500 futures to go down to close the gap, perhaps going all the way back to retest the support of 3,960, then the VIX should be able to close the gap at 19.5. That is the way I see it for now. And what about Apple? 30 minutes chart, the best performer in the Nasdaq in big cap technology stocks. The problem is that the move is getting very extended from an RSI perspective and also leaving all of these gaps. These gaps will have to be closed on a move to the downside. For now, we are looking at the center of gravity at 131. The expectations are that Apple will pull back to 131. And if it fails, then you have all of these gaps below to look forward to closing. However, from a daily chart perspective, we do have a gap higher that hasn't been closed yet. And this gap happens to be 133.19. So it is about 19 cents away. Now, understand this. When the chart reaches an important gap and it reverses before closing that gap, that is an ominous reversal signal. So I'll be watching for that, but don't be surprised if Apple goes all the way to close that gap first. So the reaction, if Apple opens higher, around 133.19 will be very important to watch. You will know right away if we have a reversal in Apple or are we going to continue higher. A reversal would be pulling back before closing the gap or closing the gap and then trending lower. But if we close the gap, face a little bit of resistance, and then closing the day above the gap, then you have higher prices to come for Apple. What about Tesla? What's going on here? We talked about the Fibonacci levels, and the line in the sand was 679. We closed at 677. I'm not going to make a big deal out of $2. So let's discuss the bullish scenarios first. And we talked about these, by the way, during the week. But here is a review. Number one, we do have a bull flag consolidation that will, in essence, act as a higher high, and we will see a breakout higher, all the way to close the gap where? The gap that we left higher at 781.30. Bullish scenario number two, pulling back all the way to close the gap at 635.5, catching support and then bouncing higher. That will also create a higher low. And if I was a Tesla bull, this is the preferred scenario because it will solidify that Tesla has a floor and perhaps a solid bottom for now. What about the bearish scenarios? Number one, going back to the gap 635.5 and failing to bounce back. That will be a very ominous signal and a confirmation that Tesla has lower prices to go. The bearish scenario number two, and perhaps this is why the bears still have the advantage when it comes to Tesla stock. The weekly perspective, which is the most important perspective. We are still showing a bear flag formation that is supposed to take us lower. And if that bear flag is going to play out, we have much lower prices to come. We have what you would call another crash in Tesla, going all the way back to the levels between 400 and 500. So for now, the bears have the advantage. For the bulls to turn the table, you gotta close the gap at 781.30 from a weekly perspective. It doesn't have to happen this upcoming week, but within the upcoming few weeks, you gotta close above that level. Moving on to conclude this video, what do we have to look forward to this upcoming week? Let's take a look at the economic calendar. On Tuesday, we have the Consumer Price Index and the core CPI. This is perhaps the most important day in the entire week, even more important than earnings, because if we have a massive surge in the CPI reading, this is the official formula that the Federal Reserve measures inflation based upon. That will have severe implications on Treasury yields. The PPI, you can brush that off. But when it comes to the CPI, if we have a reading close to 2%, then questions will start to be asked once again. You will see the bond vigilantes back at it once again. And therefore, Tuesday, perhaps the most important day in this week. Thursday will be heavy when it comes to macro data because we have the per usual initial jobless claims, but we do have retail sales, the Philly Fed Manufacturing Index, the Empire State Manufacturing Index, industrial production, business inventories, in addition to Home Builders Index. Yet again, a very important day from a macroeconomics perspective, with heavy implications to at least the bonds market. What about Friday? We do have the Consumer Sentiment Index. That will be a very important reading. It's preliminary for April, but yet it will give us something to build on all the way to the end of the month. The next thing to watch is tonight we have an interview, 60 Minutes, with Chairman Jerome Powell. And the expectations are that he's going to continue to bullshit, saying that he has done significant progress and the debt doesn't matter for now and inflation is transitory. And he's pretty much going to pave the way that if the CPI reading comes a little hotter than expected, that will be also brushed off as quote-unquote transitory. This is the job for Jerome Powell to accomplish today. And again, by the time you get this video, the interview will be already out, at least in the East Coast. The next thing to watch for is the IPO of Coinbase, because it has implications to the crypto market and a pulse to the participation of retail traders. And then we have this warning from UBS. There is upcoming volatility. Low volume, calm is always followed by higher volume and more action. And the macroeconomics data, in addition to earnings, will dictate the direction of this next upcoming very large move in the market. That's all I got for you tonight, and I will talk to you again tomorrow.